what we're going to start with is a guy who has been around for quite a while, a guy named Blair Hull. And Blair started his first firm. I think he may have started something in high school, I don't know. But he started his first serious firm in 1985. And remember, that was before Globex even existed. So he was on the cutting edge of technology. He sold this later to Goldman for about $500 million. But don't get too impressed with that because he had to pay taxes on it, so it's not as impressive as it looks. He started a new firm called Ketchum Trading, which I really kind of envy because Ketchum Trading, I assume, is named after the town in Iowa that, I mean, sorry, I didn't mean to insult you, or anybody else here from Iowa, actually. So being able to spend half your time in Idaho and half your time in Chicago, to me, seems like sort of an ideal life. But the really interesting thing, the thing that makes Blair different, well, everything so far has made him different from most people in the room. And I don't know if you guys how many of you are from Chicago or if you remember this, but back in 2004, there was a primary Democratic election for senator. Blair Hull ran for that seat. There was another guy who ran for that seat, a guy named Barack Obama. Blair lost. The cool thing, I mean, it's not cool that you lost, but the cool thing, or the interesting thing, or the amazing thing is, had he won, American history would be very different than it is right now. Now, I'm not saying that I wish that that was the case, and I think even Blair, maybe you would have liked to have been president. I don't know. I don't know if you're going to talk about that or not. But in any event, yeah, that's sort of a really interesting thing to get your head around. So, without further ado, let me invite Blair Hull.
Thank you, Michael. No, I didn't want to be president. That's a tough job. Today I'm going to talk about a few things, the trading industry, what's happened in the past, and what I think is going to be successful in the future. We're also going to talk about, I'm going to talk about the '87 crash and the flash crash, the similarities of those two, and what I think caused them. And I think it was an illusion of liquidity. This is my first trading experience. I invested $500. I could play $1 to $4 at that rate. For 5 years, 1971 to 76, I played blackjack. Played 50 days a year. At 100 hands an hour, that would be about 200,000 hands. In 1976, I moved that operation from the Las Vegas casinos to the San Francisco casino. Now, you probably don't remember the San Francisco casino, but it was also called the Pacific Stock Exchange. Now, now that $500 became $500 million, and we're going to talk about how did that happen. Well, first of all, we had a strategy. Now, in 1958, Ed Thorpe wrote, along with 3 other people, wrote an academic article, and that academic article said that, in fact, you could beat the game at 21. That later became a text or a hardback book in '62, and then a paperback book in '66. I started playing in '71, so you can see that the academic literature sometimes is way ahead of ideas, and we lean on the academic literature a great deal. Although we used a, oh shoot, this is jumping ahead. Let me look a little bit at the numbers here. Let's assume you had a $10,000 bank and you played $25 to $200. Your minimum bet was $25 and your maximum bet was $200. you could actually earn about $80 an hour. This is, these were $1974, so that's a pretty good rate on a $10,000 investment. Now, you see that .008, that was actually my lifetime batting average. I earned 80 cents for every $100 I bet. Bouncing ahead instead of, okay, but the problem here is that you don't always win at this game. If you go up for a weekend, you only, probability of winning is only 2 out of 3. Now, let's assume that you have two different players. One's got $10,000 and he can play 25 to 200. Another player's got $10,000, he can play 25 to 200. But if you combined your banks, you could play 50 to 400. You could double your earnings. And at the same time, you could increase your probability of being a winner from 2 out of 3 to 3 out of 4. So this is what really leads us to having teams not only in blackjack but also in trading operations. Now the principles, the principles of blackjack and trading are real simple. You got to get an advantage. You got to stay in the game. You get the advantage in card counting by counting the cards and playing a perfect strategy. The second one is stay in the game, and that's really an issue of betting in proportion to your advantage and in proportion to your capital. So if you lose half your capital, you got to reduce your bets in half. But emotionally, you want to get your money back, so you want to bet twice as much instead of half, but you have to bet half as much. And this ability to keep the faith in a losing streak and then to reduce your bets when you need to is extremely difficult. Well, I had 5 years of practice doing this, and I think that served me well as I moved into the trading industry. Now here's my second trading experience. The philosophy that I used trading was, I came from an options background, so I thought in terms of a fair value of an option price, but this also could be used in terms of forecasting an individual stock or a future. So, but as soon as you get this fair value and you accumulate a position, you've got to reduce, you've got to move that price. You have to move that price so that you stay in the game. If you accumulate a large position, you've got to reduce that price so you actually don't accumulate too much of a position. And then you put a bid and an offer around it. Now, I think it's interesting to look at a few of the technological changes that have occurred. It wasn't until 1981 that you could actually write a Fortran program that could access real-time prices. And then I find it interesting to see that exchanges are now computers. But in fact, those computers weren't even allowed on the floor prior to about '85. I actually had people on both the Pacific Stock Exchange and the CBOE actually remove my computer from the floor. In 1988 to 91, I was on the Chicago Board of Options Exchange, CBOE board, and I think if they'd taken a vote as to the least popular member, I think I would have won that vote. Because I said we needed to automate the process because other people are going to do it and we need to catch up. And in the process, we let the ISE actually form an automated exchange so that the CBOE then had to catch up. Moving on to take a look at I want to take a look at the '87 crash. I lived through this. I was actually in the major market index pit during that time. And prices moved almost as if there were no buyers. And actually greed took over the process. Greed normally dominates the process. This case was fear. Everybody sort of left the markets. And what happened was there was a group out in San Francisco called Leland, O'Brien, and Rubenstein. I knew Mark Rubenstein fairly well. He was a professor at Berkeley. And what he had is an illusion of liquidity. Portfolio insurance had been created that you could insure your portfolio, but when the market crashed, he assumed that he could sell futures at every single price, but he had what I call an illusion of liquidity. And I was at a party, he was at my house for a party shortly after the after the '87 crash, and he said, "I think I caused the crash." He's a very serious man. And in fact, he did, because he thought he could sell things that he couldn't sell. Moving forward to Hull Trading Company, '85, we had 5 employees. An interesting thing that Goldman Sachs did at this time when they acquired it in '99, they actually doubled the staff to about 500. They hired, in the next 2 years, they hired another 250 people. And Hank Paulson said, this is a DNA transfer. I'm going to actually take these people and I'm going to put them all through the world through Goldman Sachs and change our mindset relative to electronic trading. Now, in 2000, I knew that speed was important, but I didn't know that direct access would be so important, that I'd have to write to 13 exchanges and 40 dark pools, that I'd have to know 10 different order types on each one of these venues. I knew that I thought that price was important, but actually queue position becomes more important in trading. And I didn't know that the government, the SEC, would actually write a regulation that would give advantages to speed. And I didn't know that there was an order called the intermarket sweep order that would be necessary to be successful. Now, one of the things, this Reg NMS is extremely complicated. It is, but one of the provisions is you can't lock markets. So let's assume the market's 1-2. It's 1,000 up in the national best bidder and offer, and there's 1,000 offered on, say, NASDAQ, but there's 200 offered on the Chicago Stock Exchange, and I'm an institution. So I've got to buy, I have 20,000 to buy. I buy the 1,000 on NASDAQ, but now there's this other offer out there, so I can't lock the market. As an institution, my order is slid back to 1. I was too bad, it slid back to 1. All the HFTs see that. They go take out the 200 over here on the Chicago. Then they bid 2, and they get essentially superior queue position that they didn't deserve. So I contend that this was really, this issue of Reg NMS was a tremendous gift. I contend that Reg NMS was a tremendous gift to HFTs. Now, there is some evidence, there's a lot of evidence to say that high-frequency trading firms actually increased their profits significantly after Reg NMS. Now, Direct Edge and BATS were created at this time. Now, Direct Edge is owned by Citadel, Goldman Sachs, and Knight. BATS is owned by GetCo, TradeBot, Citicorp, Citi, Morgan Stanley, JP Morgan, and Credit Suisse. So they're essentially owned by the high-frequency trading firms. And they created an environment that was favorable to themselves. Now, wouldn't you do the same? I mean, I'm not blaming them for that, but I think that the SEC was remiss in recognizing this. Now, one of the suggestions that's made by Manoj Narang at TradeWorks to deal with this issue of locked markets is to actually allow locked markets. Because he says that a 0 spread is better than a 1 cent spread, which is better than a 2 cent spread, 2 cents wide spread. Now, there's a book that has just been released a couple weeks ago by Scott Patterson. And what this talks about is something called the 0 plus strategy. It's an interesting book because I think you're going to know a lot of the characters that are in this book. But one of the things it talks about is the old scalping strategy in the pits, where there would be 2,000 contracts to buy. And as a local, I would bid the same price as those 2,000 because I could lean on that order. And I could lean on that order. Well, the same thing happens in HFT. They get a they get Q position, and then as soon as the order behind them cancels, they cancel. So this creates this illusion of liquidity. We think there's liquidity there, but there really isn't. This book is going to describe how firms in Chicago, Houston, Dallas, and around the country took the game away from New York, and how high-frequency trading was really created. Now, a couple other things you should know about this book. The regulators had the book 3 months ago, and as a result, they have actually been studying this book extremely very well. And what has happened is, even in the last 3 months, some of these favorable order types have actually been removed and have been changed. So this book has had an impact before it was actually published. A second thing you should be aware of, it's in the hands of Carl Levin, who held the Senate hearings over on the flash crash. Now, what I contend is the difference between what HFT is really about. It's not about speed, but it's about Q position, and it's about canceling. It's about layering the orders. So an order is, they have orders all the way, you know, there are 50 different price levels that they have orders, but there really isn't liquidity there. It's sort of catch me if you can, and unless they have a complete ARB, they're not going to do it. HFTs don't take positions at night. So you see all these orders, it really isn't liquidity. Let's take a look at the flash crash a little bit. The market dropped 7% in about 10 minutes. These are 1-minute bars. It's about 4 minutes down, 6 minutes back up. The question is, what caused it? Now, the SEC has given this, obviously they needed to explain what happened. Now, imagine that you are Greg Berman. You got 20 people working for you, and you're at the SEC, and your job is to find out what happened. Now, you got a PhD in physics, you can find out what happened. I can do this. He goes through the data for 2 months, he can't find anything, and all of a sudden he sees an order for 75,000 contracts from Waddell and Reed that actually was a very smart algorithm. It only did 9% of the previous minute's volume, and so there were 140,000 contracts traded in roughly the 4 minutes that this dropped, that the price dropped. And that represents about 12,000 contracts. And these were passive orders. They didn't hit the bid, they were just offers there. And the SEC claimed that the Waddell Reed really caused it. But I contend it was the appearance, the illusion of liquidity. People thought there was liquidity and there really wasn't. But this can, so we need to address the market structure to prevent another flash crash rather than blame it on one smart algorithm. Now, my views are supported by an academic article. We try to stay close to the academic world. And now, here are my recommendations. I recommend that we allow ban markets. I think that we need a minimum order life. The SEC is having this be the acknowledgement time of the exchange. I think it ought to be 200 milliseconds. Some people say a second, but I would compromise with 200 milliseconds. I think we need to discourage cancels. Now, the CME has done this to some extent. ICE has tried to do this a little bit, but we need to be more aggressive on charging for cancels, not for transactions, but for cancels. Now, a couple other things. Microwave technology is going to be covered later in this conference. There will be, I think it's going to be inexpensive to get less than a 9 millisecond line. What's speed worth? Manoj Narang, again, at TradeWorks, has a graph that gives you an estimate of 2 to 3 mils per millisecond. I think he's overestimated that somewhat. Now let's take a look at the future of trading. I think that I view the world in these 4 quadrants. We got futures, securities, those would be stocks and ETFs. Got options on futures and options on securities. Now, so there really, I consider 8 paths there. We're dealing in 3 of those paths right now of information transfer between markets. But as we go to continents, we need to look at across continents too. These microwave lines are being used to reduce the speed even across continents. One by going to New York to up to Nova Scotia. In order to be a, let's see, wait. It's costly to become a trading firm. These are, I think it costs at least $200,000 a month to actually be in the trading business effectively. So how does a small firm survive? I contend it's through coopetition. And firms need to cooperate on a variety of things. And one of the issues that comes up, does one share his secret sauce, his real algorithms that he thinks are giving an edge? I contend that secret sauce is overvalued. It's really the execution, and you need to cooperate and coordinate on execution. Now, moving on to what does Ketchum Trading do? We have a core business that has 13 people that build our strategy. But we also support other teams of, and we provide infrastructure, low-cost clearing, and we give feedback. Now, so if you have a strategy that you think has a great high Sharpe ratio, you've got a team of educated people, and I look at this in terms of three. There are three skills you need. You need a trader, you need a financial engineer, and you need a developer. Now, you can't get, you could get that in all one person, but I have seen teams be successful. I have not seen individuals be successful. So here are my conclusions. The trading business is tough. It's a very difficult business. You need to combine things across asset classes and across geography to be successful, and coopetition is, in fact, an advantage. As for regulation, crashes are caused not by a specific order, but by the market structure and the illusion that there are bids and offers there. Waddell and Reed did not cause the flash crash. And I think the SEC can make markets fairer and more stable if they really understood the problem. Thank you.
We just have just if we're quite time pressed, but we do have a chance for just one question, maybe one or two questions.
Jeremy Walton from NAG. In terms of those suggestions that you had for the cause of the flash crash and your recommendations, what sort of impact do you think those are going to have? Are you speaking directly to the SEC about your recommendations there?
I think that this book that was written is speaking to the SEC. I was disappointed with the TAC, Technical Advisory Committee, and their definition of HFT. I think it's possible that the HFT, the high-frequency trading firms, don't even know the impact of what caused it. I think this idea is just now becoming apparent. So I don't think they understand it yet.
Any final questions? Okay, another big
I may be wrong on this too.
Okay, another big round of applause for Blair. Thank you.
Thank you.